A slowdown in demand for products manufactured in Asia has ocean carriers reducing freight rates on shipping routes from China to the West Coast and canceling sailings, despite elevated fears about a new round of supply chain inflation caused by the Middle East conflict. The cargo price cuts come despite the Houthi rebel attacks in the Red Sea, which led some shippers to recently raise container fees as high as $10,000. Shipping giants including Maersk, which have had to halt shipments through the Red Sea in recent weeks, continue to warn of the ongoing threats to the global economy. As the US and its allies launch attacks against the Houthis, fears are running high about an inflation spike for the global supply chain, but the latest shipping contract data shows that on some key routes that is not yet happening. Rates for new ocean freight contracts scheduled to go into effect Monday, January 15 for many carriers were expected to rise above $5,000, but a new advisory to clients from Honor Lane Shipping shows Asia to U.S. West Coast container prices coming in below that level. U.S. East Coast routes remain higher, at $6,500 to $7,000. Alan Baer, CEO of logistics company OL USA, said there appears to be a growing divergence between the shipping rates to the U.S. coasts. U.S. West Coast rates have rolled over and are decreasing, Baer said. More shippers were expected to start avoiding the East Coast and favor the West Coast ports as a result of the Middle East issues. Diversions from Egypt's Suez Canal, which feeds into the Red Sea, and the rerouting of vessels around the Cape of Good Hope adds 2 to 4 weeks to a round-trip voyage, according to Honor Lane Shipping, and ocean carriers need more ships on each Asia East Coast route to maintain an efficient network schedule. But Baer says the data does not support the view that the situation has shifted more trade to West Coast routes. Perhaps the diversion away from the U.S. East Coast has not prompted as significant an increase to U.S. West Coast volume as first anticipated, he said. Baer says there could potentially be more cancelled sailings to come in February to help balance actual supply and demand. Still, rates are in flux, reacting to a very sensitive market, and pricing pressures will remain, according to Goetz Alebrand, head of ocean freight for the Americas at DHL Global Forwarding. Ocean freight rate adjustments are made in the same each week nowadays, said Alebrand. It could be seen as an adjustment to supply and demand. We expect this situation to remain fluid but generally see more chances for rates to remain elevated. The ongoing drought issues at the Panama Canal, which this week led Maersk to reroute some cargo by a land bridge, are adding to the global freight complexities. Ch.